How many vendors does it take to meet all your organization's food needs? Just one. EasyCater, the workplace food platform that lets teams order from a huge variety of restaurants, over 100,000 nationwide, all through a single vendor. In addition to all that variety, EasyCater also gives you full visibility of your organization's food spend with invoicing, centralized reporting, and seamless integration with expense management systems, all on one platform. EasyCater, your business tool for food. To learn more, visit easycater.com/podcast.
These days, AI can help you adopt better time management, but it can't stop colleagues booking meetings during lunch. But how about being able to easily adopt industrial AI to streamline your business? Siemens Accelerator helps you find the right AI providers and easily understand what they offer, so you can use modular solutions to quickly scale up and grow your business. That's AI for real, from the global market leader in industrial AI, Siemens. Learn more on usa.siemens.com/AI.
Running small and medium-sized businesses is hard work. Business owners need to be sure their ads are working just as hard as they do. Amazon streaming TV ads makes your marketing dollar work harder. With Amazon ads, trillions of insights help small and medium businesses reach the right customers that matter. Your ads will show up during the shows the people are actually watching, and measurement tools show you what's working the hardest. Gain the edge with Amazon ads.
Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Daybreak Weekend, our global look at the top stories in the coming week from our Daybreak anchors all around the world. Straight ahead on the program, Federal Reserve Chair Jerome Powell opening the door to a possible interest rate cut as early as next month. Plus, earnings from the AI chipmaker Nvidia amid worries about its business in China. I'm Tom Busby in New York.
I'm Stephen Carroll in London. We're looking at the difficult calculations looming for European governments as they prepare their spending plans for next year.
I'm Doug Krisner, looking ahead to this week's rate decision from the Bank of Korea, as well as the state of the IPO market in Hong Kong.
That's all straight ahead on Bloomberg Daybreak Weekend. On Bloomberg 1130 New York, Bloomberg 99.1 Washington, D.C., Bloomberg 92.9 Boston, DAB Digital Radio London, Sirius XM 121, and around the world on BloombergRadio.com and the Bloomberg Business app.
Good day to you. I'm Tom Busby, and we begin today's program with some revealing statements from Federal Reserve Chair Jerome Powell about possibly changing the Fed's stance on rates. That's ahead of inflation and personal incomes and spending data in the U.S. We're joined by Stuart Paul, U.S. economist with Bloomberg Economics. Well, Stuart, I just want to hear your takeaways from Friday's rather dovish speech from Fed Chair Jerome Powell, because it looks like Wall Street's already pricing in a rate cut at the September meeting.
Well, the hot headline that we got from the speech at Jackson Hole is that the balance of risks for the Federal Reserve and for monetary policymakers are shifting. And in particular, the downside risks to employment are shifting materially. They're rising. So if anything, the Federal Reserve Chairman was opening the door, or at least acknowledging the cooling labor market and opening the door to a rate cut in September. But if anything, I think the tone of the speech was actually a little bit hawkish. So we could be getting something like a hawkish cut in September. He was really trying to keep people from reading too much into the idea that the resumption of rate cuts would mean a cycle of cutting follows. For example, he noted that the labor market is cooling, the pace of hiring is materially slowing, but there is not a lot of slack in the labor market. The pace of GDP growth is slowing, but there's not a lot of slack in economic activity. Yes, risks to inflation are still skewed to the upside. So he was very cautious in his tone. He acknowledged that it might be time to adjust the stance of monetary policy, but he was not willing to go so far as to say there would be multiple sequential cuts.
Well, what he said about employment is we're in a curious kind of balance right now in the Labor Department. So he is hedging his bets. And when you say a hawkish cut, you just mean a quarter percentage point, right?
A quarter point cut and a clear signal at the time they decide to move rates that additional sequential rate cuts are not predetermined. When we get something like a hawkish cut, it's really an incremental loosening of monetary policy plus hawkish messaging. And that's what Powell was starting to signal in his final Jackson Hole speech.
We have had some dissension previously in the Fed. Some members saying, hey, we're ready to cut any time. Has that balance shifted now? Do you think it's not just him, not just the one or two, Christopher Waller and a few others, are more saying this may be the time?
Heading into Chairman Powell's speech, other members of the FOMC, the branch presidents, including Susan Collins from Boston, Austin Goolsbee from Chicago, Beth Hammack from Cleveland, they were very clear that they had not yet made up their mind that this is the time to cut rates. There was a coalition in July, and it seems like there's still a coalition now that is very cautious about moving to looser monetary policy right now. But I do think that what we saw from Chairman Powell, who does speak mostly to the central tendency of the committee, that central tendency, that median FOMC participant is probably getting a little bit more comfortable with the idea of moving relatively soon. But I think that this is what's most important. This relatively hawkish tone that was included in the speech, even with signaling that they're becoming more comfortable with one rate cut, it would just be probably one rate cut. And I think that there could be a negotiation come September that it's time to lower the federal funds rate target range by 1/4 point, but they would move slowly, they'll move deliberately, they'll move cautiously, and probably not another time this year. From an economic perspective, does it really matter if they move in September or November or December? No, it doesn't really matter from an economic perspective. So I think that the chairman can build a coalition. Given the fact that there had previously been dissension, he can build a coalition now that would be more amenable to lowering the federal funds rate target range, as long as they feel like they're not getting too far out ahead of their skis and that they're not devoted to sequential rate cuts.
Well, one thing the chairman has been consistent on is that his decision, the decision of the central bank, will be data dependent. And we're getting some important data this week. July PCE, the Fed's preferred measure of inflation, and also personal incomes and outlays. Just on Friday, the chairman said that the result of the Trump tariffs has been now clearly visible, but the effects may be relatively short-lived. So, is he seeing inflation as maybe it isn't so bad?
For the month of July, we're estimating that core PCE prices rose 0.3% on the month. There was actually relatively less pass-through of tariff price pressures in the month of July. We had seen some in April, May, June, a little bit less in July. Where a lot of the core inflation pressures are going to be coming from is actually from financial services prices. This is a lot of things like portfolio management fees, for example. And when you see financial services prices rising, it's mostly just a reflection of a rally in the equity market. It's a rally in financial asset prices that are feeding through into financial services prices. And so there's an extent to which the committee is going to be looking at this July PCE inflation report and thinking, there are elevated, frothy asset markets. And so even if we decide to cut rates in September, even if we decide to cut rates this year, we should be very slow and deliberate in doing so. We still have a reasonably close federal funds rate target to what we consider to be neutral right now. Monetary policy is only modestly restrictive, if it's restrictive at all. So we should move very slowly.
July PCE and personal spending both out just ahead of Wall Street's opening bell this Friday. The next Fed meeting, September 16th and 17th. A lot to look forward to. Our thanks to Stuart Paul, U.S. economist with Bloomberg Economics. We move next to earnings from the last of tech's Magnificent Seven to report this period, AI chipmaker Nvidia. Those results from the world's only $4 trillion company are looming large over Wall Street because of all the spending on artificial intelligence and questions about the company's business in China. For more on what to expect and what may be next, we're joined by Kunjan Sobhani, Bloomberg Intelligence Senior Semiconductor Analyst. Well, Kunjan, thank you for being here. Nvidia shares, they've taken a few hits in the past week or so, and there are questions about tariffs and what looks like a setback in its ability to sell chips in China. So with all that, looking backwards, what are you expecting to see in its second quarter results?
From a results and guide perspective, we expect Nvidia in its typical fashion to deliver again a strong beat and raise. Our checks suggest strong Blackwell ramp ongoing and also strong networking attach along with it. So that should boost both compute and networking. The GB300, which is their next version of Blackwell GPUs, also is likely to be running ahead of schedule. So that can also help with a guidance beat. But from a stock reaction perspective, the key focus again will be on narrative rather than purely numbers, as we have seen over the last few quarters. First, a key topic front and center is the magnitude and the timing of resuming the China sales. They have now received the license approval from the Trump admin, but there are still a lot of unclarity and moving parts regarding how soon can they restart production and start shipping. If those customers are still there wanting the same H20 parts, news has come out, which hasn't been confirmed yet, but there seems to be that the Chinese government forcing the customers not to buy Nvidia chips. So there's a lot of moving parts around that China angle, which will be very important.
Well, those chips that the Trump administration has given Nvidia the access into China to sell, they're less powerful. Certainly not the Blackwell chips. These are older chips. So the Huawei's and the other companies there, do they make a similar product? I mean, is that the reason why, if this is confirmed about Beijing saying, we don't want your chips?
At this point, there is, if you take the best available GPU over in China, yes, it is comparable to the older H20s that Nvidia is selling. But regardless of that, those GPUs don't have enough supply capacity because they don't have access to the leading edge fabs as Nvidia does. So, if there was no pressure from the Chinese government, the customers would happily and readily buy a lot more of the H20s. So right now, it's a lot more geopolitics driving this scenario rather than just pure demand, supply, and performance comparison.
Well, Reuters reported last week that Nvidia may be working on a new chip, a little more powerful than the H20, that is just for China. Has this been confirmed?
This has not been confirmed. And again, this is a lot of news has come out over the last few weeks, which everyone, including us, is waiting to speak to the company as they report earnings to confirm a lot of these things. And I wouldn't be surprised regarding that new chip. Every big generation leap, architectural generation leap, Nvidia has designed a new chip for China. So now as it is shipping Blackwell, it makes sense that it is designing a lower powered Blackwell version, which is what the Reuters news was talking about. And so that would not be very surprising to us. But again, you would have to go through this whole cycle of getting licensing and sanctions, because it will be definitely more powerful than the H20.
Well, with all of this, it's a $4 trillion company. How important is China to NVIDIA's future revenue? I mean, it looks like they're doing well without it, but we all know it's the second largest economy on earth. The spending is astronomical. How big is China to NVIDIA?
Yeah, so there are two parts to it. One is from a TAM perspective. It's definitely the sort of biggest TAM outside of the US when it comes to what Nvidia can sell to. And it is home to the next largest hyperscalers and cloud providers. So it's definitely a big market that you don't want to lose out, especially if you're Nvidia for the long term. But however, in the near term right now, it can do very well without it. It is doing very well without it. We don't suspect that this China headwind will stop from it growing into the numbers and estimates. But right now, given the size and the growth it has delivered, the focus is how better can you do. So even if it's just, let's call it $10 to $20 billion a year right now, which is a drop in the bucket given how much revenue they're selling everywhere else. Because all the investors and buy side is trying to just get to the highest number. And if they can beat that to that, the narrative will be a lot more important right now than the numbers.
Well, NVIDIA's Q2 earnings out after the market closes this coming Wednesday. Our thanks to Kunjan Sobhani, Bloomberg Intelligence Senior Semiconductor Analyst. And coming up on Bloomberg Daybreak Weekend, we'll look at the difficult calculations looming for European governments as they prepare their spending plans for next year. I'm Tom Busby, and this is Bloomberg.
For enterprise organizations, managing all your food needs is a tall order. But with EasyCater, you get a single workplace food vendor with the tools and resources to make it easy. giving teams across your organization an easy way to order from a huge variety of restaurants, all on one platform. All while consolidating your corporate food spend so you can control costs, streamline billing and payment, and simplify reporting. EasyCater, your business tool for food. To learn more, visit easycater.com/podcast.
These days, AI can help you write emails, summarize long meetings, and even create presentations that impress your most demanding customer. But how about industrial AI that uses data and simulation to boost productivity on the shop floor? AI tools that help you understand machine language. AI that helps you grow your business. With Siemens Accelerator, you can use AI services, software, and consulting from a single trusted digital business platform. Plus, you can find the right AI partner without having to search through hundreds of providers. That's AI for real, from the global market leader in industrial AI. Siemens Accelerator. Learn more at siemens.us/accelerator.
At GSK, we believe that to get ahead of disease, you need to understand its root cause. And that's why we combine our deep understanding of immune science with cutting-edge technology. It helps us to create targeted therapies that match the right treatment to the right patient, transforming the lives of millions. By uniting science, technology, and talent, we work tirelessly to get ahead of disease together. Visit gsk.com to discover more.
This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Tom Busby in New York. Up later in our program, we'll look ahead to a monetary policy decision from South Korea's central bank. But first, in Europe, the end of the traditional summer holiday period will see politicians return to work in the coming days. In many countries, their biggest challenge will be drawing up budget plans that increase defense spending while also tackling enormous debt piles amid weak economic growth. In France, the conversation will kick off at the annual summer conference of the country's biggest business group, Medef. For more, let's go to London and bring in Bloomberg Daybreak Europe anchor Stephen Carroll.
Tom, it's a cliche, but politicians do take summer holidays in Europe, and that usually means that at this time of year, the looming political challenges return with a bang. In France, the season known as la rentrée for schools, but also for politics. This year's Medef Conference is a chance for employers to set out their positions ahead of a fractious budget debate. The Prime Minister, François Bayrou, faces the daunting task of building support in Parliament for his budget plan, which contains 44 billion euros of tax rises and spending cuts. Without a majority, his government's future hangs in the balance. Bayrou will be trying to avoid the fate of his predecessor Michel Barnier, whose government was toppled over its budget last December. The situation is causing growing concern amongst investors, not just in France, but also in several other European countries. Many governments are grappling with similar budgetary issues, and they need to submit their spending plans to the European Union by mid-October. They're balancing the need to increase defence spending, pay bigger social welfare and pension bills for their ageing populations, and cover debts incurred during the COVID pandemic, all the while trying to avoid painful tax rises or spending cuts. Here's what Jefferies economist Modupe Adebembo had to say about the situation when she spoke to us on Bloomberg Radio.
In previous kind of budget cycles last year, the opposition knows that they can extract the gains from the government, and so they will do that. But I think the question is how far it goes. Will it just be a case of trying to maybe remove certain budget reductions that have been penciled in, or will it be a case of bringing down the government? And I think if we get into that situation where it's a case of bringing down the government, that's where I see, it's a really big risk for France there, because another election, then we're thinking about presidential elections, a lot of uncertainty about who would come in presidential elections. I think it really opens up a really big can of worms, and that's why we are negative on France, because I think all of these sorts of scenarios that we're talking about are very possible. They of course tell risks, but they have a greater probability.
That's Jefferies economist Modupe Adebembo speaking to me recently about the situation in France. Let's get into the broader political and economic challenges ahead then with our senior geoeconomics analyst for Europe, Antonio Barroso, and our European economist, Anna Andrade. Welcome to you both. Antonio, I want to start with you and just to lay the land of the political situation in France. They're heading into these difficult negotiations. What is the situation looking like for the government?
Well, the picture is looking quite challenging, I would say, because the main problem is that the government lacks a majority in the National Assembly. That's the crucial lower chamber in France. The government is essentially short of 79 deputies, right? And I think that means two things. The first is that it's very hard to get legislation passed in Parliament, not just a budget. I mean, this is a government that struggles to get things done in Parliament. And the second problem is that it basically leaves the government exposed to potential no confidence motions in Parliament. And that, if a non-confidence motion is supported by the Parliament, that leads to the collapse of the government, which is what happened last year, right? So I think that creates a very challenging situation for the government. Adding to this is the fact that there is a lot of political polarization in the country. Political parties are extremely polarized, which makes reaching compromises also very difficult in Parliament. So as a whole, I would say it's fair to characterize the political situation as quite difficult.
Anna, let's turn to the fiscal situation that France is facing. How did it get to this position, and how does it compare to what we're seeing elsewhere in Europe?
Sure. So I think the markets really woke up to France's fiscal problems in 2024 when Macron called a snap election. But really, the problems had been building way before that. And if you look at the primary balance, which provides a better reading on fiscal efforts, because essentially it excludes interest payments, while Greece, Italy, and Portugal, all the countries that had been most affected by the sovereign debt crisis, were undertaking big consolidation efforts and targeting primary balances surpluses away from deficits, France was still running significant deficits. Now, it wasn't the only one. Spain was not necessarily, very committed to fiscal discipline as well. But the key difference then, as now, was that growth was much faster there, which helped reduce the debt to GDP ratio prior to the pandemic, while in France, it actually increased. And now, then we had the pandemic, which made everything worse. And France, in particularly, has had a problem in reining in spending over the past few years. Now, that's due to a mix of factors, including slippage by local authorities, growing spending in pensions, and disappointing tax revenues. And the government's plan is quite ambitious. It's committed to that. I mean, obviously, the politics of it are quite difficult, as Antonio said. But I would just flag that we also just don't know where these savings beyond 2026 are going to come from, because in the medium-term structural plans that France sent to the Commission, and by the way, this is not a France-only problem, it's a problem across all the governments. They sent sort of the debt deficit targets that they want to reach in 5 to 7 years, but they just haven't detailed the tax and spending decisions that will underpin those targets. So the plans are really not credible.
Well, let's discuss that further, Antonio. I mean, it was unusual to see the French Prime Minister lay out the first draft of his spending plans quite early in the summer. There was lots of unpopular proposals in it, like cutting 2 public holidays, for example. What chances are there really of being able to get a compromise on a budget for France?
Well, just like last year, where essentially the government collapsed over the budget and then a last-minute emergency budget had to be approved, I think it's going to be very hard for the government to get the budget passed. In a survey that was done in July by French pollster Elab, you could see that 72% of respondents said that they acknowledge that debt must be reduced, but that the efforts being demanded by the budget by the government are too great, right? So it's not a popular budget. Also, same survey, 66% of respondents say that they want opposition parties to file a no confidence motion against the government, right? So you can see it's not a particularly popular budget, and the challenge of the fact that you need to really engage in fiscal consolidation to reduce the budget deficit is compounded by the lack of a parliamentary majority. But that doesn't mean that the government cannot make some concessions. In fact, I don't think the budget in its current form might be able to be passed, but I think the government can provide certain concessions to at least have a chance to get it approved by opposition parties.
And Antonio, because we're thinking about this in the context of this upcoming business conference, where of course employers and business leaders are going to be very worried about what it could mean for them fiscally. They've previously been asked to give larger contributions in terms of payroll taxes towards the French budget. I mean, how worried do employers and perhaps citizens have to be about tax rises being part of an eventual budget package in France?
Well, I think that depends on the final compromise that the government, if the government can get a compromise, that the form of that will take. So, as I said, I think there is room for concessions, and I think that's, by the way, probably why the initial draft of the budget looks so tough, because I think the strategy of Prime Minister François Bayrou is essentially to present a very tough budget and then leave room to negotiate with opposition parties. But obviously, fiscal consolidation is never popular. So the problem is that opposition parties do not want to be associated with the consolidation efforts. That being said, if you look in terms of potential compromises, so last year, the previous government of Prime Minister Barnier tried to make concessions to the far-right National Rally Party of Marine Le Pen, and then that backfired in the end. Actually, a no-confidence motion, as I said, was voted, and the government ended up collapsing. So I think the government is not going to look at its right. Rather, it might look towards its left, where you have the Socialist Party, which has rejected the budget in its current form. But I think the strategy might be to try to offer some concessions on what the socialists call fiscal justice, which is essentially increased taxes on the highest earners in the country. So I think ultimately you might see some concessions that might look like tax increases, even though the government would try to keep those at a minimum because Macron and Bayrou are really fixated on not increasing taxes. But that might be an area where you might find some concessions that might lead ultimately to the approval of the budget.
Anna, in terms of the broader economic outlook for France and for the euro area, I mean, what should we be watching out for, I suppose, the potential pitfalls as policymakers are considering what effect their decisions might have on the economic trajectory for the country?
Yeah, I mean, growth in France in the euro area hasn't been spectacular over the past few years, but I would say that given all the shocks that the currency bloc has been hit by, I think it has been holding up fairly decently. Of course, there's a big heterogeneity across the euro area. We have Spain, Greece, and Portugal really experiencing decent growth runs, while Germany barely growing. France is somewhere in the middle. And now when I think about the outlook over the next few years, I think it's going to be essentially shaped by three things. One is fiscal, and in that I'm including, the defense spending. The other is obviously US tariffs, and the third one is euro appreciation. Now, the euro area had a strong start at the beginning of the year. Essentially, that was due to front-loading ahead of the US tariffs, and that should ensure that growth is above 1% this year. But the pace of growth, at least in our forecast, we expect it to moderate over the coming quarters to around 0.2%, 0.3%, which is really below trend. And for 2026, we expect 0.8%. Now, it could be worse, and it could be worse generally for the euro area if we hadn't had this sort of fiscal loosening coming from Germany. Germany has engaged on a spending splurge in infrastructure and defense, which we expect to start feeding through next year. But I would say that fiscal loosening is really a story that's contained to Germany, because in other countries, as Antonio just now said, the trend in France and in Italy, for instance, is one of fiscal tightening. So the support from that will be modest. And then the big question is how tariffs and uncertainty will play out. Tariffs will affect all countries, obviously, to different extents. And we expect, we've had a trade deal been reached, which sort of maybe provides some stability, but taken together with uncertainty, we still expect that to drag on growth. And we're actually expecting a 0.4% hit to the level of GDP at peak. So, there will be some growth, but it will be modest and sort of, brought down by tariffs and uncertainty overall.
Okay, Antonio Barroso, our senior geoeconomics analyst for Europe, and our European economist Anna Andrade. Thank you to you both for helping set us up for what is expected to be a long debate over the French budget and the European budget cycle to come. I'm Stephen Carroll in London. You can catch us every weekday morning here for Bloomberg Daybreak Europe, beginning at 6 a.m. in London and 1 a.m. on Wall Street. Tom?
Thank you, Stephen. And coming up on Bloomberg Daybreak Weekend, we'll look ahead to a monetary policy decision from the Bank of Korea. I'm Tom Busby, and this is Bloomberg.
How many vendors does it take to meet all your organization's food needs? Just one. EasyCater, the workplace food platform that lets teams order from a huge variety of restaurants, over 100,000 nationwide, all through a single vendor. In addition to all that variety, EasyCater also gives you full visibility of your organization's food spend with invoicing, centralized reporting, and seamless integration with expense management systems, all on one platform. EasyCater, your business tool for food. To learn more, visit easycater.com/podcast.
These days, AI can help you write emails, summarize long meetings, and even create presentations that impress your most demanding customer. But how about industrial AI that uses data and simulation to boost productivity on the shop floor? AI tools that help you understand machine language. AI that helps you grow your business. With Siemens Accelerator, you can use AI services, software, and consulting from a single trusted digital business platform. Plus, you can find the right AI partner without having to search through hundreds of providers. That's AI for real, from the global market leader in industrial AI. Siemens Accelerator. Learn more at siemens.us/accelerator.
At GSK, our focus is on doing the right thing for patients. We believe they should be free to focus on doing what they love, especially when they're living with a disease like cancer. That's why we focus where we can make the biggest difference, matching the right treatment with the right patient. At GSK, we're pioneering advanced technologies like antibody-drug conjugates that precisely target and attack cancer cells. By uniting science, technology, and talent, we work tirelessly to stay ahead of cancer together. Visit gsk.com to discover more.
This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Tom Busby in New York. South Korea's central bank faces a tough call on rates next week. Economists are divided over whether the BOK will extend its easing cycle or keep the current 2.5% rate unchanged. For more, let's get to the host of the Daybreak Asia podcast, Doug Krisner.
Tom, South Korea's economy rebounded in the second quarter, although recently the governor of the Bank of Korea, Ri Cheng-yong, said it still faces high levels of uncertainty as a result of U.S. trade policy. Now, trade is just one of many factors the BOK will have to consider in the week ahead. For a closer look, I'm joined by Bloomberg's Brian Fowler. He is Senior Asia EcoGov Editor for Bloomberg News, joining us in the Japanese capital of Tokyo. Thank you so much for making time to chat with me. As I recall, the BOK meeting in July, when the policy rate was held steady at 2.5%, at the time, Governor Ri seemed to keep the door open to a rate cut this month. Has anything changed between then and now?
Well, Doug, so he definitely kept the door open to a cut. He said at the time that 4 of the board members, that's 4 out of 7, were open to a rate cut sometime in the next 3 months, and that's a pretty clear signal that the bias is towards further easing, and probably further easing pretty much in the short term. He also cited concerns about household debt and the housing market in Seoul, and that tends to raise the risk of financial imbalances, and that's something he wants to keep an eye on. And I think another reason why the BOK began its pause in June and July is that there were fading thoughts of the Fed easing policy, and the BOK tends to want to move in lockstep with the Fed in order to avoid putting downward pressure on the won. The won was the weakest major currency against the dollar of last year, and that revved up inflationary pressure. So that's one thing they want to keep an eye on.
So when you look at the household debt story, I'm curious, is that more likely to be concentrated in mortgage lending, or are there other forms of borrowing that may trouble the Bank of Korea?
Mortgage lending is absolutely the key factor there, because that's driven by the housing market in Seoul. When it's hot, and people tend to borrow money to speculate on that market. And we've seen housing prices rise now in Seoul for 28 consecutive weeks. But on the other hand, the pace of increase has slowed after the government took some steps to cool demand, including putting some restrictions on mortgage lending.
So where do we find the inflation story right now in South Korea? I know that the recent numbers on consumer prices earlier in the month seem to suggest a bit of deceleration. And I just saw the recent print on producer prices. They advanced at an annual rate in July by 0.5%. Is that considered hot?
The consumer inflation is a little bit hot. Consumer prices rose 2.1% in July. The BOK has a target of 2%. And core inflation rose 2%. So it's right about at the BOK's target. I think going forward, the BOK wants to see if the tariffs have an inflationary impact on prices, and if that feeds into the economy more broadly.
So the tariff story is obviously a key part of the trade story. And when I think of South Korea, I think of not only automobiles, semiconductors as well. How have trade flows been, especially to the U.S., in light of these tariffs.
We had some early trade data for August showing that exports to the U.S. Have started to fall. Until now, we had a lot of front loading, so exports held up relatively well. Also, companies like Samsung Electronics, the tech sector, did pretty well because the Trump administration put some exclusions on consumer electronic goods, and that's helped put a floor under those exports. Also, of course, the supply chain relationships with Apple have helped as Apple has managed to win some exemptions. Going forward, though, as you mentioned, I mean, the outlook is pretty cloudy. Trump has threatened to put new tariffs on chips by the end of this month, and that would be a huge threat to South Korea's economy because it relies very heavily on trade, and in particular on trade of semiconductors.
So when you think of sentiment on both the business side and the consumer side, what's it been like? How are people feeling?
I think they're feeling a little bit worried about how things are going. The Bank of Korea's GDP forecast for this year calls for 0.9% growth. That would be the weakest performance since the pandemic, when the economy contracted in 2020. And I think people are thinking the shoe is about to drop. It hasn't really dropped thus far, and there's concern about how things happen, how things unfold from August on.
Now, I know recently, within the last several months, there's been a little bit of turbulence on the political side in South Korea. Have things calmed down right now to help maybe support the idea that the BOK has a little bit more flexibility to do its job and not to be distracted by political developments?
Definitely. The new administration got started, obviously, in early June, and that's taken away a huge source of uncertainty. Lee so far has done his best to first of all, put aside any sort of concerns about diplomatic spats with Japan. And I think that's he's looking confident, and that's meaning that the government can come through with fiscal stimulus if it feels that it needs to.
That is Brian Fowler. He is Senior Asia EcoGov Editor for Bloomberg News, joining from our studios in Tokyo. Let's pivot to one of the most important equity markets in Asia. Hong Kong Exchanges and Clearing posted record quarterly profit, a gain of 41%. Trading surged with average daily turnover nearly doubling, and new listings rebounded with IPO applications topping 200. The exchange's CEO is Bonnie Chan, and she recently told Bloomberg how she is optimistic about international investors returning to Chinese assets and how that will keep momentum strong. Here is part of Chan's conversation with Bloomberg's Yvonne Mann.
Another quarter of record profit. You have trading that's been booming, and now more than 200 active applications on the pipeline. What stood out to you for this quarter?
You know, what really stands out for me for this quarter is the fact that it's riding on a pretty sustained momentum. If you look at our results, this is actually another set of record half-yearly results. We deliver a pretty strong set already for the second half of 2024. And so for me, my biggest takeaway is that actually since, I think, September 2024, gradually we're seeing a return of interest from international investors, and they want to, again, look for opportunities to deploy more capital to this part of the world. You see it, I think, manifested in many ways, in our daily turnover, but also, I think, in the way that all these investors around the world are participating in our IPOs.
The key question is it sustainable? You mentioned about average daily turnover, which you nearly doubled from a year ago. Yes. Obviously, with liquidity, has been quite ample with these southbound flows. Yeah. What could extend this streak?
Right. International investors are really, again, focusing on China assets. And I think as they try to come back to treasure hunt, it is a very good thing that we have equally a robust pipeline to match their appetite. I think that is very, very important. So you mentioned our pipeline. We have currently over 200 companies already having filed their applications. And in fact, on a daily basis, I'm speaking to a lot more. So I think, with the backdrop of, really the interest returning in earnest, as well as all these very exciting investment opportunities coming online, I do hope that the momentum can carry on.
How confident are you that Hong Kong can reclaim the #1 IPO venue this year?
Yeah, people always ask me that question. I think it's certainly good to be sort of all the way at the top of the league table. I mean, at the moment, we're in a very good position. And we do have the pipeline to help us deliver and help us stay up there. But to me, the more important thing really is to make sure that we are able to support the fundraising needs of these companies. And this year, I keep talking about the IPO pipeline. I think we also need to look at the follow-on fundraising, which in fact has raised more money than the IPO proceeds. So year to date, we have raised about $16 billion, close to 17 for by way of IPOs, but we have actually more than $40 billion raised by companies already listed on our exchange. So to me, so long as we continue to support the fundraising needs of these companies, we continue to improve our listing framework.
Are you still doing a lot of marketing, or do you think companies are starting to come to you now?
Well, I think both. I mean, companies certainly, I think, saw how well we've done in the IPO space. And so I think on the average, I probably meet 2 to 3 companies per day, all sort of wanting to understand more what we have to offer. And I want to expand the universe a little bit. I think it's very encouraging that in the past few months, we have seen an increased appetite of companies beyond just the mainland China, wanting to use Hong Kong or pick Hong Kong as their listing venue.
We've seen a bit of a quiet resurgence in the A-share market, and the IPO market there seems to be coming back to life again as well. What does a rebound in Shanghai and Shenzhen mean for the pipeline here?
I think that will be very, very encouraging because the way I see it, we always say the capital markets is there to serve the real economy. So the fact that capital markets are doing well, should suggest that actually, there's a lot of positive momentum in the real economy as well. China is a big country. It is producing a lot of very exciting investment opportunities. I mean, you see our pipeline, right? It's really filled with a lot of excitement. And there's certainly enough for more than just Hong Kong to support. And I think increasingly I'm seeing the few exchanges in China, right? So Shanghai, Shenzhen, Beijing, and the Hong Kong market really playing a very complementary role. Now, for Hong Kong, I think one advantage we have is certainly the connection to the rest of the world. And therefore, for a lot of companies, when they decide to pick which venue to list, one thing which will gravitate them towards Hong Kong is if they have overseas expansion plans. And we actually saw that in a lot of companies which have been listed in the past few months. They want to raise proceeds. They want to therefore use the proceeds to expand overseas. And I think that is one thing which Hong Kong can actually serve the best.
That was Bonnie Chen. She is the CEO of Hong Kong Exchanges and Clearing, speaking with Bloomberg TV host Yvonne Mann. And I'm Doug Krisner. You can catch us weekdays for the Daybreak Asia podcast. It's available wherever you get your podcast. Tom?
Thank you, Doug. And that does it for this edition of Bloomberg Daybreak Weekend. Join us again Monday morning at 5 a.m. Wall Street time for the latest on markets overseas and the news you need to start your day. I'm Tom Busby. Stay with us. Top stories and global business headlines are coming up right now.
These days, AI can help you adopt better time management, but it can't stop colleagues booking meetings during lunch. But how about being able to easily adopt industrial AI to streamline your business? Siemens Accelerator helps you find the right AI providers and easily understand what they offer, so you can use modular solutions to quickly scale up and grow your business. That's AI for real, from the global market leader in industrial AI, Siemens. Learn more on usa.siemens.com/AI.
Every business has an ambition. PayPal Open is the platform designed to help you grow into yours. With business loans so you can expand and access to hundreds of millions of PayPal customers worldwide. And your customers can pay all the ways they want with PayPal, Venmo, Pay Later, and all major cards, so you can focus on scaling up. When it's time to get growing, there's one platform for all business. PayPal Open. Grow today at paypalopen.com. Loans subject to approval in available locations.
So, have you heard the story about the prescription plan with savings automatically built in? It's where a family of any size can feel confident the cost of their medication won't hold them back. Go to cmk.co/stories to learn how CVS Caremark helps members save just by being members. That's cmk.co/stories.